concerned, right? I mean, you're concerned about a signal or series of events that are going on that indicate the market could be in for something here. Explain.
This is an incredible pattern, Neil. It's something I discovered in the mid-1990s, and it was almost serendipitously. I was looking over at market data, and I saw a pattern. That pattern was it related only to the advances and declines on the New York Stock Exchange. I recognized that pattern as being something different. I put it into the computer, and I said, tell me when this pattern has happened before. And the computer ran, and it gave me these instances, like the top in 61, the top in 66, the top in 68, and it gave no other instances. And I said, oh my goodness, this is remarkable. So then I finally got the data going back to the 20s, and there was one signal, Neil, between 1926 and 1961, and that occurred in July of 1929. And I threw up my hands and said, oh my goodness, we really have something here. The sign of the bear doesn't know what Alibaba is doing or what Amazon's doing or who the new Federal Reserve Chairman is or what's going to happen with interest rates.
It's a technical thing. It's a technical thing, right? So what?
Absolutely, Neil.
Tell us technically what it's picking up, what you're picking up.
Okay, what I'm picking up is that on October 5th, we had this pattern. I'll tell you what it is quickly, but I don't want to get too involved. Sure. It's 18 consecutive days where the advance decline ratio on the New York Exchange, advances divided by declines, is either below 195 or above 0.65. So it's kind of a churning range. That churning range turns into, if you get 18 consecutive days and you break out of that to the downside, in other words, with a ratio below 0.65, and you get 2 or 3 days of follow through, that's your pattern. And that's the sign of the bear. It's been incredible, Leo. The last one we had was in September of 2000, right at the top, within a week of the top of the New York Composite Index.
Wow. So in other words, when that happens, and for a sustained number of days, how soon does the bad stuff happen?
That's a great question, and it varies. It's not a signal that says you better settle all today, get out of all your stocks today, or you're in trouble. In 1929, for instance, it took another 10% to the upside in about 5 or 6 weeks. There have been instances, that's the longest you had to wait, by the way, price-wise, to see a move against you. But remember, after moving 10% to the upside in 29, we had a little move of 90% to the downside. Wow. So I would call that a well-timed signal. So that's the type of thing we're looking at here, Neil. One other thing I want to mention, 17-year cycle in the market. If you go back to the inception of the Dow Jones Industrial Average in the 1890s and look at these dates, 1898, important bottom, 1915, right around World War II, important bottom, 1932, important bottom, 1949, 17 more years, a kind of sideways move to an incredible move to the upside, 1966, the next 17 years, a very important top in the market, which lasted for 16, 17 years. The next one was due in 83. It happened 5 months early in 82. The next one due in 2000. I would say that's perfect, especially for the NASDAQ. And guess where we are now, Neil?
Wow.
2017.
Well, Robert Prechter had said, Peter, that he sees at least a 20% hit coming to these markets, which, of course, for a Dow would be close to 5,000 points just wiped away. What do you see? What do your charts tell you?
You know, if I were to tell you, Neil, and I know why Robert didn't do it either, we would be accused of bear mongering and telling people things to scare them. And boy, those technicians are out again, especially Eliades and Prechter, are out there again scaring people, telling them.
Well, people who know your respective histories and respect what the research that goes into it, I don't think they would say that some do. But again, spell it out.
Okay, I'm spelling it out for you. I would say at least as bad a bear market as 07 to 09, at the very least. And that was more than 50%.
Yeah, that cut us in half. So let me ask you this. It's more of a political issue, and I know you don't take sides when you're just looking at the markets. You're not red or blue. You're just looking at the direction of the green or lack thereof. Yeah, when you see the president constantly talking about the records in the market and keeps going up, 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 there's a flip side to that, too. You own it on the way up. You own it on the way down, right?
I know. If I could tell Trump, President Trump, I'd bang him on the head and say, President Trump, you have to understand that you're going to have to own the downside too. And of course, he might very well think there isn't going to be any while he's in office. And the sign of the bear says something different. That's why I crawled out of my cave in Dunlap, California. I crawled out, Neil, and I said, really, people should know this. So I'm out of my cave, and I'm telling you that, Neil, and I have great respect for you for putting stuff like this on the air, because a lot of the media don't want to hear it now. I've written several articles for Barron's. They don't want to hear about things like this. They think that they can prevent bear markets by not writing about them if there's an indication of them.
Yeah, but the Barron's has high praise for your sign of the bear, signs and all that, and a lot of people do. And I always think, to your point, Peter, it's only right to have both sides, the bullish and the bearish side. So, well, you mentioned the 1966 period. I believe then the Dow briefly pierced intraday, maybe 1,000. It didn't convincingly close over until 16, 17 years later. So what's to say that we have a market that doesn't necessarily tank 20, 30, 40, even 50%, but goes sideways for that long? Could that happen too?
I can't rule that out. I don't think that's going to happen, but we can't rule it out. All the sign of the bear tells us. And by the way, Neil, I should, in all honesty, say there have been 2 failed signals of the sign of the bear in 90 years. They occurred like 10 months apart in 93, 94, and I cannot explain them. There's nothing to say that we can't have another failed signal. I'll be the first to admit that.
But would a failed signal, Peter, would a failed signal to you, I mean, the argument against this happening, I know from a non-technical, more fundamental perspective, is that interest rates are very, very low. Balance sheets are very, very good. We have a very accommodated sort of a global Federal Reserve, central bank phenomenon supporting this. So you don't buy that?
I'm glad you brought that up, Neil. Let's look at latest unemployment report, 4.1%.
Right.
Look at the 17-year cycle in relation to the 4.1%. You know when the last 4.1% unemployment was? The year 2000. You know what happened there. Go back 17 years, it worked the other way around. The high unemployment rate of around 10.5%. You go back 16, 17 years from there, and the cycle has worked very well with the unemployment rate. But one of the things that's scary, Neil, is the fact that we are at a 4.1% unemployment rate, and that has not been good for the market. That kind of good news turns out to be bad news for the market. So
tax cuts, whether they come to fruition or not, don't move the needle on this.
Yeah, that's one of the other things I was going to say. The sign of the bear doesn't know anything about tax cuts. It's incredible that this little 18, 21-day pattern that knows nothing about fundamentals at all it knows about is how many stocks are up and down for the day on the New York Exchange. How does some pattern like that pick out these turning points? I have no idea how it's done, Neil, but I know it's worked for 90 years, and so I have